Journal Trust here, and the Federal Reserve is taking proactive measures this year to prepare for potential financial crises by focusing on stress testing, monetary policy adjustments, and economic monitoring, right? So here's a breakdown of what they have done so far. We have the stress testing and risk assessment. So annual stress tests, right? The Federal Reserve has released hypothetical scenarios for its 2025 stress test to evaluate the resilience of large banks. These tests simulate severe global recession conditions, including a 5.9 percentage point rise in the U.S. unemployment rate to 10%, a 33% decline in house prices, and a 30% drop in commercial real estate values. There's the severe market volatility and widening corporate bond spreads. The exploratory analysis. So in addition to standard stress tests, the Fed is conducting exploratory analysis to assess risks from specific sectors like real estate and corporate debt. So these analyses aim to ensure that banks remain well capitalized and capable of lending during economic downturns. We have monetary policy adjustments like the interest rates. The Federal Open Market Committee, FOMC, has signaled gradual interest rate reductions in 2025 with 225 base point cuts expected, one in June and one in December. So this approach balances inflation control and supporting economic growth. We have inflation monitoring. So core inflation remains above the Fed's 2% target, prompting careful adjustments to monetary policy. The Fed is prepared to ease policy further if labor market conditions deteriorate significantly. So economic projections and growth, you have this slower growth, right? The Fed projects GDP growth of 2.1% in 2025, down from earlier estimates reflecting trade policy impacts and elevated inflation risks. So unemployment trends are as goes, right? It's expected to rise modestly to around 4.4% by year end, influenced by public sector layoffs and reduced consumer spending due to government cost cutting measures. Now, there's the broader context of this, right? The Fed's actions are part of a broader strategy to maintain financial stability amid uncertainties such as trade policies, global economic conditions, and domestic fiscal challenges, right? So corporate leaders and analysts have expressed concerns about an impending recession, citing reduced corporate spending and rising unemployment as key risks. So by leveraging stress tests, cautious monetary policy adjustments, and close monitoring of economic indicators, the Federal Reserve aims to mitigate potential financial instability in 2025 while supporting sustainable economic growth. So, it's kind of tough out here, Banks are strengthening capital buffers, right? They're focusing on maintaining robust capital levels to absorb potential losses under adverse economic conditions. They are also adjusting risk-weighted assets to optimize their capital requirements. Banks are reviewing and rebalancing their portfolios, particularly in areas like commercial real estate and corporate debt, which are highlighted as vulnerable sectors in the stress test. Okay, so that's what I have for you today. Please take a moment right now to hit that subscribe button and the like button if you gained value from this video. Let me know that by hitting that subscribe button and the like button right now. I appreciate your viewership. Stay safe and see you on the next video.